Let's start in East Africa's biggest economy. Kenya risks losing duty-free and quota-free access to a $1.3 billion agricultural produce market unless it ratifies an economic partnership agreement with the European Union. Now, the EU takes up nearly a quarter of all Kenyan exports, and a failure to sign a new deal with that bloc will see the EU impose punitive taxes on produce from Kenya. Freshly cut flowers make the bulk of Kenya's exports into that market, so CCTV's Peter Akaba spent the day at a flower farm just to figure out what this EPA agreement would mean for this sector.
The cut flower sector is regarded as one of the most robust sectors of the Kenyan economy. It's a status which could soon change if the deadline to sign a trade deal to guarantee free access to the 28-nation European Union expires. Kenya and other East African member states have been negotiating with the EU as a bloc since 2002. An interim agreement was reached in 2007, and the European Commission continued duty-free, quota-free access via a temporary instrument which ends on the 1st of October 2014 for a number of countries, including Kenya.
They are now profiting from the so-called market access regulation, and that is guaranteeing free export, duty-free, quota-free of all products to the European Union.
Statistics indicate that in strict trade terms, the EU is Kenya's biggest trading partner, accounting for around 25% of the country's total exports. EU-Kenya reciprocal trade in goods has continued to grow in recent years, reaching more than $3.25 billion in 2012. Kenya's main exports to the EU are flowers, which accounted for 37 billion shillings, or $435.2 million in 2012, tea and coffee worth $376.4 million, or 32 billion shillings, and vegetables, mainly peas and beans, worth 18 billion in 2012, or just over $200 million. This is the market in jeopardy should the East Africa community fail to accede to the economic partnership agreement.
The result would be that instead of now being in a position to export all of this duty-free and quota-free into the European market, there will be a duty put on it, and that duty would be 6%.
According to the European Union, the objective of the EPA is to upgrade the existing interim agreement, which since 2007 has guaranteed tariff-free trade for all EAC exports into the EU. Its critics, though, have termed the agreement lopsided and said it will expose developing economies to dumping, a position strenuously denied by the EU.
It's also a reciprocal agreement. They will open progressively their market for European products, but that has an important grace period of 7 years for sensitive products, and for the most sensitive products even 15 years.
East Africa Community and European Union officials meet in Arusha in July to take deliberations forward. The export of cut flowers is a mainstay of the Kenyan economy, accounting for a large chunk of the foreign exchange that ends up in this country, not to mention employing hundreds of thousands of Kenyans. This vibrant sector could now be in jeopardy unless the Kenyan government agrees the terms on a new economic partnership agreement with the European Union, and fast. Peter Akaba, CCTV, in Ruiru, just west of Nairobi, Kenya.
Now, Jane Giga is the Chief Executive Officer of the Kenya Flower Council, an organization that's quite literally in the front lines of this trade dispute, with billions of dollars of trade and hundreds of thousands of jobs on the line. She joins us now live in studio. Mrs. Giga, in early May, Kenya's Deputy President essentially indicated that he would like to have EPA deals concluded as fast as possible. As an industry, how did you react to his comments?
With a lot of hope that in the coming days we shall be able to negotiate the remaining 3 to 5% of what is left of the agreement. And the outstanding issues are really of a political nature, so we do expect that this will not be an impediment to the finalization of the agreement.
Does the fact that you have to negotiate, however, as a bloc under the East African Customs Management Act, does that make your work a lot harder or a lot easier? Because presumably you have to talk to Uganda and Tanzania and Burundi and Rwanda in order to get anything done.
Initially, yes, but with time we all understood that we had a common objective, particularly because the agreement is actually supposed to foster regional integration as well, and also build capacity, which it has done substantially.
For the record, however, what positions do each one of these states hold? Aside from Kenya, of course, what other positions do the other 4 countries in the EAC hold with regard to the EPA clauses on agriculture?
With the understanding that, of course, Kenya will benefit substantially, they are all now working as a team with one voice, and mainly because they all realize that with time, the other countries will also be upgraded to least developing country status like Kenya, and will not continue to benefit from the everything but arms status that is current at the moment.
Indeed. Finally, Mrs. Ngige, the clock really is ticking at this point. We still don't have a deal on the table. Given the government's drive to conclude a deal for EPAs, what's the outlook for the flower and the horticulture industry in general in Kenya between now and October 2014?
Very positive. When you look at the progress that we're making with the agreement, it's very, very positive. And also the fact that right now the negotiators are working on a text. And once the text is complete, it will then be taken back to the countries to be able to sign and ratify. And we have every hope that this will progress to conclusion.
Indeed. We'll have to leave it there for the time being, though. Thank you very much for your insights. That's Jane Ngige, Chief Executive Officer of the Kenyan Flower Council, speaking to us live in studio. Let's move on to North Africa now, where the country's interim Prime Minister, Hazem Al-Bablawi, has named the liberal economist Ahmed Galal as Finance Minister. The appointment comes after the country's stock market experienced its sharpest rise and fall within the span of the last week amid a festering political crisis. The ouster of Mohamed Morsi from power on the 3rd of July, so the stock market recorded a 7 percentage point rise on the 5th of July. However, it fell sharply after the clash between the military and Morsi supporters, in which over 50 people died on the 8th of July. As one economic analyst notes, however, the appointment of Hazem Al-Bablawi as former finance minister as the interim prime minister is just what the markets were looking for to bounce back.
The newly appointed Prime Minister used to work for international financial institutions. He's also an expert in economy. Moreover, Arab countries such as the United Arab Emirates, Saudi Arabia, Kuwait all announced large amount of economic aid for Egypt. So the stock market is expected to go up in the foreseeable future, especially after the situation improves in Cairo.
Let's move on to something you don't often see in this end of the world. Spain has the second largest Moroccan community in the world after years of economic migration and close economic and geographic ties. However, with unemployment running at over 20%, migration flows are now turning in the other direction, with Spaniards crossing the Mediterranean heading south in search of jobs and economic opportunities.
Just a short hop across the Straits of Gibraltar, Emilio arrived here in Tangiers from his native Spain in search of a brighter future. He now runs a small construction business in Morocco and has left behind the worries of the economic crisis devastating his home country, where his sector is one of the worst hit.
There was nothing left there. The crisis stopped all my construction work, swimming pools, construction materials for bathrooms, polyester. There was nothing left to do in Spain. There was no work there, no financing from the banks, and everyone was fleeing.
Maria also traveled south across the sea in search of work. With a daughter to support, she says the cost of living is too much to bear in Spain.
I had a salary which wasn't good. I didn't want to live like that anymore, just working to pay the bills.
With the country in recession since 2011 and the unemployment rate at a record 27%, many Spaniards feel they have little option but to leave. In Morocco, they've taken work at call centers or set up their own businesses. Unemployment in Spain is at 20%. Official figures put the number of legal Spanish workers in Morocco at about 2,500, with an increase of 100 during 2011 to 2012. On the ground, the figures are thought to be much higher.
I know a lot of people right now who are asking for work a lot. I receive emails all the time from Spaniards who want to come to Morocco. Jose is responsible for watering the grass at the golf course.
I see this work as a chance to travel, to get to know Morocco, and above all to work, because right now things are bad in Spain. The truth is that here in Morocco, it's better.
The Moroccan Interior Ministry now requires new arrivals to register their professional activities. Officially, Spaniards are allowed to stay in the country for 3 months on tourist visas, but it's clear that many intend on staying for much, much longer. Maria Galang, CCTV.
Let's take a short break now. Here's what's coming up next. We're taking you to Somalia, where consumers are now enjoying high-speed internet access as a new 3G network is rolled out across major cities.
Talking tough on trade, conflicts over currency, and connecting economies around the world. From Tokyo to Shanghai and Mumbai, BizAsia links you live to the markets and brings you all the latest in business from China's unique perspective. BizAsia, a smart investment for your time.
Welcome back. Ethiopia expects to join the World Trade Organization about 2 years from now without meeting demands that it liberalizes its state-run banking and telecommunications sectors. Now, even though the country has registered remarkable economic growth over the last 6 to 10 years, it has followed its own doctrine, if you will, of state-led development. As CCTV's Girum Chala now explains.
The Horn of Africa country has been waiting since 1997 to join the organization. After its accession process was accepted in 2003, the country started negotiating with WTO for membership.
The process of accession is it begins from submitting the memorandum of foreign trade regime. Accordingly, the memorandum of foreign trade regime document was prepared and submitted to WTO in December 2006.
If all goes according to plan, Ethiopia can hope to join the WTO in 2015. The US and Canada have been urging Ethiopia to open up its economy. Both nations questioned the Ethiopian proposal and sent around 200 questions to be answered by Addis Ababa before joining the group.
After replies of those questions and preparation of relevant documents that are expected to be submitted to the WTO Secretariat, the third working party meeting was held in 2012. That's the basis of the negotiation. You negotiate on goods and you negotiate on services.
Despite the fact that Ethiopia has not yet liberalized its economy as required by WTO, the progress of joining the organization as a member is going well, and the government of Addis Ababa believes all deals with World Trade Organization will be made based on the national interest of Ethiopia, not the principles of the global organization. The agreement now is to make Ethiopia a member of the World Trade Organization before the country claims the middle-income economy status. It's been a tough journey, but an important step to further integrating Ethiopia into a global economy. Grumjala, CCTV, Addis Ababa, Ethiopia.
CCTV's Miriam Ahmad is live in London. She joins us now on the line. Miriam, let's put some numbers really on this story. What's at stake if Ethiopia does join the WTO?
Well, the WTO, Rama, is most famous for standardizing the member states' trade to international levels. It also helps reduce barriers like tariffs, subsidies, and import quotas. Now, implementing international commercial law standards to boost both domestic business and attract new foreign investors is the aim. In fact, the IMF suggests that Ethiopia needs to join to help the economy, which only grew at about 7% this year, far less than the government's 11.3% target. Now, the government has tentatively unlocked some sectors to foreign investors to raise export earnings, especially with an $8 billion trade deficit. But, low savings as well is certainly not helping the economy, on top of state-imposed requirements to buy loss-making government bonds, reducing many of the bank's capacities to actually lend. So it also doesn't help that about 25 sectors, including banking and telecoms, are still close to outside investment and hopefully can be up for negotiation.
Indeed, one of the arguments that Ethiopia's government has used to justify locking out private capital is saying that it will not open up those sectors until it's ready to effectively regulate them. But what benchmarks, what empirical benchmarks will be used to determine if it's able to effectively regulate those sectors?
Well, the government will have to submit an offer to the WTO on access to certain services, like, for example, for financials. Now, the big concern on a domestic front has been Ethiopian businesses having to compete with foreign businesses and the government losing autonomy over major sectors like banking and telecoms. Now, some experts that we spoke with say the Ethiopian government may have to negotiate on access to certain sectors, but it won't be forced to give up control over vital sectors. Now, this was already revised by the WTO last year, allowing countries to join without giving up autonomy over what's deemed as strategic sectors. But Ethiopia will have to liberalize some sectors to channel in new flows of money. And at this point, the WTO is still waiting for the Ethiopian government to actually provide its own policies on services on service industries and foreign trade. So we're really waiting on the Ethiopian government to provide the framework of which it wants to do business within the WTO.
Indeed, we'll have to leave it there. Quite a bit of work to be done by the Ethiopian side. We'll have to leave it there for the time being. Thank you very much for your insights. That's CCTV's Mary Bemart live over in London. Now, from Ethiopia to her neighbour to the east, Somalia. High-speed mobile internet access usually isn't something you'd normally associate with that country, but that's not the case anymore. One of the mobile service providers in the war-torn state, Hormuz Telecom, now provides 3G internet access to its clients in several major cities right across Somalia. As CCTV's Mohammed Hirmogi reports, however, the only complaints clients have so far over there are about prices.
Somalia's largest mobile service provider, Hormuz, launched the country's first 3G service for its subscribers to ease faster internet access. This service, Hormuz said, will allow subscribers to browse with new peak data rates different from the slow data transfer speeds that was initially available in Somalia.
We have this service in major cities. 30% of our customers now use the 3G service. Everyone with a phone can enjoy faster browsing without necessarily going to a cyber cafe.
Hormuz's 3G has, however, been criticized for high costs. Subscribers say only a few could afford the service.
Browsing with 3G is fun. We are happy that we can enjoy faster internet even with the conflict over here. But we hope the service provider would lower surfing rates. 3G is faster and better, but it comes with a cost. The browsing charges are high. Sometimes it uses all the credit in your phone.
3G is a standard used for mobile devices and mobile telecommunication services and networks that comply with international mobile telecommunication specifications. Somalia's telecommunication industry thrived despite the conflict that raged for 2 decades. Hormuz Telecommunication, the country's leading mobile service provider with an estimated 1.7 million subscribers, is the first to have launched the 3G service here. The service is fast expanding and is expected to reach all parts of the country. CCTV, Mogadishu.
Dar es Salaam, Tanzania's commercial capital, is smack in the middle of a construction boom, even before the money starts to roll in from recent offshore gas discoveries. Now, over time, analysts do expect revenues from the offshore gas discoveries there to make the East African nation a major energy exporter, especially in regard to gas. But they also warn that there are plenty of reasons to be worried. Benefits from an economy that grew by 7% in 2012, for example, aren't trickling down to everyone. The pace at which legislation needed to manage the country's natural resource revenues is being worked on is also a concern. Now, economists there argue that in future, Tanzania must overhaul and liberalize its heavily subsidized power sector. However, raising electricity tariffs to reflect the real cost of generation, transmission and distribution will be a very hard sell in a country where many now expect cheap electricity from domestic resources, especially in the wake of those gas fires. Let's make a quick run through the markets on the continent here for you. Starting, of course, as we usually do, on the western end of the continent in Nigeria. The oil share index was higher by about 0.9. Over in South Africa, the JSE oil share ended the day in the red, but only marginally so, down 0.02 percentage points. The real story today, as far as trends go, was right here with the Kenyan currency and the 20-share index. This was up by about half or so percentage points. However, the Kenyan shilling did require a bit of central bank intervention. It went up to about 87.60 against the dollar, came back down to 87. That's a trend you certainly have to keep a very close eye on moving forward. And finally, the Egyptian market also ending the day in the green, but only marginally so, up by just about 0.1. 17:50 GMT. That's BizAfrica. Back to Beatrice now for the sports.